Alright, today's bank is Bancorp Incorporated. It's in Bethesda, Maryland. So we looked at this bank about a year ago, and we felt like its credit quality was not good, and so we didn't buy it. But so if you see the chart for the past year, I think it was about $26 whenever we saw it back then, and now it's down to 18. So maybe we made a good decision to avoid it, but as it is, it's a pretty small bank, kind of on the it's below the normal range of the size of banks that we see for the publicly traded ones in our population. So 558 million. It's got a PE ratio of 7. That's pretty cheap. A dividend yield of 9.72%. That's pretty outrageous, outrageously high. So so it'll be interesting to see. Well, is there a particular reason that it's cheap, or so if we go to the statistics, we can also see price to book of about 0.44, so that's really low. We would typically see something I think like 0.9 to 1.10, something like that. So it seems like it's priced really cheap compared to its earnings and its net assets. So it'll be interesting to see why that is. Return on assets is pretty low, 0.67%. We'll typically see something like 0.85 to 1.05%. So we've got a pretty perhaps a lower profitability bank, but also the price might be low enough to justify it. So anyway, let's dive into what's going on with the bank. We can come down to the balance sheet. So what we see here is about a little over 700 million of cash. It's a pretty good amount. It's about 6% of the assets. And then securities is about 2.5 billion. That's pretty good. That's about 20% of the balance sheet. So both of these, the cash and the securities, is about a bit more as a percentage of the assets than what we typically see. So perhaps a little bit more liquid bank. So that's good. If we look at the loans, it's about 8 billion gross. And it's a little bit on the lower side. So it looks like they're a little bit more allocated towards securities and cash than they are to loans in relation to most banks. So perhaps we would see a little bit less interest income than what we would normally see, unless they're allocated to more risky loan types that yield more, or the same thing for securities. So we'll know more once we dive into the footnotes and kind of see how everything's set up. They have non-interest bearing deposits of about 1.8 billion, and that represents about 17% of the liability side. And that's a little bit low. We usually see somewhere between 20 and 25% right now. So this being a little bit low, that means that for the majority of their liabilities, they're having to pay interest expense on them. It's not egregiously low. In this environment with where the interest rates have gone up a lot, there's been a lot of migration into more interest-bearing deposits, or even more investments that the bank doesn't offer, that might offer a higher yield or a higher return. So not outside the norm. It's just that would force the bank to have higher cost funding sources. And then we also have, it looks like, so the borrowings is about 1.7 billion. I think it's mostly made up of FHLB borrowings, as is usually the case for most banks. Actually, I think part of it, if I remember, is the bank term lending program that was offered by the Federal Reserve over the past year. due to the securities losses and whatnot, allowed banks to borrow money at the amortized cost of the pledged securities rather than at the fair value of the securities. So that allowed them to borrow a lot more because the securities had a lot of built-in unrealized losses. But anyway, that's a different story. So then we can see that the bank is a little more allocated toward higher cost funding sources. Seem to have a lot of time deposits and also debt. So I would more than likely we'll probably see interest expense being a lot. So let's dive down into the income statement, and we can see a little bit more about the profitability of the bank. We see about 175 million of interest income, and that is about 6.36% of assets, and that's a really high amount. That's a pretty good yield. And most of it looks like comes from loans. So 6.91% is what the loans are yielding on. At least in this quarter. So and that's a really high amount. For the first quarter, we're usually seeing something like 5.25% to 5.75% yield on the loans, at least for the banks that we've gone through so far in the first quarter. So that's a really good yield on the loans. So it'll be interesting to see what kind of loans that they are invested in, and then securities probably about average. So really good interest income, about 6.36% of assets. So coming down to the interest expense side, we've got $100 million, and that is about 3.95% of assets, and that's a really high amount. Basically 4%. They're paying 4% on their liabilities, and that's basically like double what we've been seeing over the past year. And of course, interest rates have gone up, and there's been migration and stuff, but it's pretty expensive interest expense currently. So if they're making 6.36% on the assets and paying 4% on the loans, that leaves them about a 2.5% net interest income, which is pretty low. We normally see somewhere around 3%, so 2.5% is low. So they're not making as much on net interest income as what the average bank is, and so that might be a source of their profitability. And also, 35 million provision for credit losses. I think this is where the profitability is taking a hit. That's actually half of their net interest income gone. So that's last quarter it was 6 million. Now it's 35 million. The last time we looked at the bank, we saw they had some credit quality issues, but I guess, man, ouch, that's a lot. That's about 1.79%. Most of 1.79% of assets, I believe. No, it's 1.79% of loans. So normally the provision will see something like 0.11, 0.2%, 0.1, 0.2% of loans, but they just recorded 35 million. That's almost 2% of the loans they just made a provision for this quarter. So ouch, that's a lot. So half of their net interest income, and so then they don't have a lot of non-interest income either. So 3.6 million, that's like 2% of the revenue, and then 40 million of non-interest expense. So that's a really low amount, 22% of the revenue. So they're saving a lot of money on the non-interest income, fortunately, but it doesn't. So the net interest income after the provision is 39 million, and then they've got to pay another 35 million for the net non-interest stuff. And then income tax, yeah, they're left with nothing. Ouch. So if it hadn't been for this huge provision, they might have eked out about 35 million of profit. So 35 million, yeah, so 35 million annualized, so multiplied by 4, and divided by its assets of about 11.6 billion would get about 1.20%. So that would be a really good return on assets. But as it is, they had to record this 35 million. They're left with no income. So it would be interesting to see, like, is this 35 million kind of a one-time thing, And if that's the case, as we're looking out into the future of the earnings of the company, could we take out that 35 million from the provision and normalize it to where we've got, as if that was a one-time thing, but in the future we don't expect it, so we can add it back to the net income and consider that as what we expect as a normal income. And I don't know the answer to that yet, because we will have to look at the credit quality and see, like, well, now that they've made that provision, is the reserve enough to cover the problems and that were, or potentially still are, in the loan portfolio. So anyway, man, that's an interesting dilemma. That hurts. So a zero profitability bank, it's hard to justify buying it unless we could make the case that this was one time and in the future it won't happen, right? So anyway, so as this is, you've got a 0% earnings yield. That makes your price earnings infinite. So I'm not sure what the ratios on Yahoo Finance were, what income they were considering. But as it is, this investment would be a no-go unless we can make the argument that the provision was a one-time thing. And then, even if we made it to where, maybe 6 million is the natural provision, then that would mean there's about 29 million, call it 30 for easy math. Annualized, that would be 120 million. Yeah, 30 times 4, 120 million of net income. So as a ratio of the market cap, that would be about 21.5% earnings yield. So if we could justify that the 35 million provision was one time, and then actually in the future we should expect about 30 million of net income every quarter going forward, and then we paid 558 million for the company, then we would earn over 20% the earnings relative to the market cap, and that would be a fantastic price. So if the price is that enticing, I could almost guess that it won't be the case that we can ignore this big provision and this big goose egg this quarter, right? So, and then of course the bank would be no-go. At any price. Well, there's always a price, but there's a certain level of risk that I don't want to take, right? We're looking for base hits. We're not looking for home runs. We want to get on base and bat around and score, right? We don't want to have strikeouts. So anyway, so let's keep on going. We can get down to the footnotes, and hopefully we learn a little bit more about the credit quality and why there was such a large provision, and then learn whether the credit quality is now, or the reserve is now enough now that we have made that huge provision, and if the credit quality is still poor, then we might have to avoid the bank altogether. Another thing to think about is like, whenever I'm going through this analysis, I read all the 8Ks as well. There's been a lot of executive management changes, resignations, or people being let go without cause, that type of thing. And that's always a little bit unnerving as well. Perhaps they've found some new qualified people to get in there. But yeah, and they're also, I think they had they put a shelf registration to raise $150 million. So that would be helpful to shore up some of the lacking in credit quality. But $150 million for $11.5 billion bank isn't a whole lot of money, right? I guess it adds, when you're looking at just the equity, it adds a substantial amount to get them perhaps whole. But anyway, so those are some things to think about as well whenever we're considering the investment prospects of the bank. But they're even though they're $11.5 billion asset bank, they've only got I think 17 branches, or 16 now. They had to close one of them, so that's another thing to think about as well. They've had to downsize. 12 plus 4 gets us 16 banks, and they're located in DC, Maryland, and Virginia. So over in that geographical area. But if we can go down to the footnotes, get past all the accounting policies here. Here we go. Yeah, the securities. Okay. All right. So as is the case with most banks, we've got a lot of mortgage-backed securities here. It's like about, if you were to add all this up, it'd be about $1.4 billion. And then they've got 639 of agencies. So 639 here. Yeah, so we could say, 60 plus, the agencies is about 28%. So the mortgage-backed securities being 60% plus agencies of 28% gets us about 88%. Yeah, 88% of the securities portfolio is pretty much riskless, either guaranteed by the U.S. government or is the U.S. government. So then a little bit of corporate debt, but next to nothing. So about 5%, which is about normal. So they might have a little bit of a reserve. And that would be good, but even if they don't have one, that would be okay, related to the securities. Yeah, so it looks like they've got a provision of 17,000 on the available for sale, and then 2 million on the held to maturity. So yeah, I feel like that would be appropriate, given that most of the securities are government backed. And then looking at the term structure. If you remember, 60% of them are residential mortgage-backed, commercial mortgage-backed, so we won't be able to see the repricing of those until we look at the call report. But yeah, so it looks like most of the remaining ones mature. 22% of them mature in 1 to 5 years. So we'll know more about the interest rate risk and the repricing duration once we get down into the call report and more into the interest rate risk and the MD&A. We can also keep in mind that about 2.1 billion of the securities are pledged, and I think that is at amortized cost, which ends up being, it's about 82% of the securities are pledged. So that leaves 18% of them for on balance sheet liquidity, but we'll consider those things later on as well. Okay, yeah, now we're down into the loans. Hopefully we'll learn a little bit more about why um, the provision is so high and whether it's fixed now. So it looks like most of the loans are commercial real estate, and these are non-owner occupied commercial real estate as well. Okay, yeah, non-owner occupied commercial real estate is more risky because the they're paying the loan with the tenant's rent, right? Owner occupied, you're paying the loan with the business of the tenant. So there's one less derivative removed, I suppose. But it's well established that the owner-occupied commercial real estate has better credit quality than the non-owner-occupied. Anyways, especially in this environment with the office issues and stuff, that's pretty common fear, vacant offices, that sort of thing. Anyway, so we see that yeah, so most of the loans outstanding is commercial, and also most of them are commercial real estate. So, remember that the interest income was a whole lot more, or not a whole lot, it was more than what we would normally see for most banks, and that might be why. The reason that might be is because we're a little more allocated toward commercial loans and to commercial real estate. And that almost also might be why the credit quality is so poor, or that we identified the credit quality as being poor a year ago, and then this year them having to record such a high provision. Um, we can so it should get into more of the credit quality stuff. Yeah, so there's the ACL. All right, so let's take a look at how things look now. All right, so they've got an ACL in place of about 99.7 million. It's about 1.25% of loans, which is it's pretty average. That's usually what we see from most banks, is that they've got a reserve for about that amount of their loans. So that's good. And the issue would be, should their allowance be more if their loans are more risky than the average bank? And hopefully we can learn a little bit about that as well. So collateral dependent loans here are the ones that they're expecting to be paid by the collateral, as opposed to being paid by the terms of the loan. So it looks like that they've got 92.1 million collateral dependent loans, and that's about 1.15%. That's almost 3 times what we would normally see for most banks. So they basically got triple the collateral dependent loans. That's not good. As far as the credit quality indicators, so classified, we're looking at the classified loans, so either substandard or doubtful. This is where they've got an identified weakness in the loan, where they're more than likely not going to get paid the full amount. So commercial loans, 61 million. Commercial real estate, we've got 200 million plus 66 million. 4.2 million, 29 million. There's a lot here. So if we added all those up, classified loans is 361.9 million. Wow. As a percentage of loans, that's about 4.5% of loans. That might be the highest I've ever seen. And at least over the past few years. Ouch. So, we might normally see somewhere between 1 and 1.5% of loans being classified. These guys have 4.5. That's, that's 3 times. 3 times the average bank's amount of weak loans. And, non-accruals and past dues, we've got 91.5 million of non-accruals, and that comes to about 1.15% of loans. That's almost 3 times what we would normally see for most banks as well. So this isn't looking good. Past due loans, 31 million, plus the 91.5 non-accruals. Those together comes to 122. That's about 1.5%. That's almost 3 times the average bank's amount of past due loans as well. So if we were to, oh wow, I was going to skip over this part, but TDRs, because there's usually not a lot going on in the TDRs, right? Or loans that are modified. Borrowers experiencing financial difficulty. They just recently renamed it from TDR, but so those is about 85 million, and that's just in this quarter. Yeah, during the 3 months, 85 million. They modified 85 million loans, which $85 million just in this quarter, and so that's a little over 1% of the loans, which that's way more than we would normally see. I mean, normally this is a very negligible amount. So not only are they having issues with the loans in the portfolio, but they're also having to renegotiate the terms with their customers, so their customers are able to actually pay the loans. And wow. So in the past 12 months, they have modified, looks like almost $250 million, and yeah, that's just outrageous. Never seen anything like that. It may have been like this last year, or worse, and maybe that's why we decided, no to the bank, even though it might have been a really, really cheap price. So anyway, if we compare all that stuff to the reserve that they have in place now, and the reserve was, what was it, like almost 100 million? Oh, went too far. So the reserve, yeah, 99.7 million. So if we compare the reserve to all those things, so the reserve to classified loans is about 28%. Normally we see at least 100%. Most banks have a reserve that covers the classified loans amount. This bank has 28% of the classified loans covered. Reserve to past dues is 81%. We normally see somewhere between 200 and 400%. So, they've way under accrued for past due loans, way under accrued for classified loans. For non-performing loans, which it's basically the non-accruals plus 90 days and accruing plus OREO, is about 108% of assets. The reserve is 108% of non-performing loans, and or non-performing assets. So we normally see somewhere between 260, 450%, something like that. So they have 100% of them accrued. So wow. So it seems like maybe the unusually high provision that they had this quarter might not be enough to mitigate the potential losses in the loan portfolio, unfortunately. So if we were to think about this from a dollars standpoint, the classified loans, 360 million. And, we normally want a reserve to equal the classified loans. And they've got 100 million reserved, so 360 million minus 100 million is $260 million that they are under accrued on the reserve, in my own judgment. And they might not have that much of losses and only the future can hold for that. But what I can say is that the average bank would have a reserve in place to cover all that. So if they wanted to put their reserve in line with that of the average bank, they would have to take a $260 million hit to their income statement. And as we saw, pre-reserve for a quarter, they only make 35 million. So that would mean that if they take a $260 million hit on their to make more of a reserve, 260 divided by 30 million, it would take them over 8 quarters, so over 2 years of zero net income to get back to normal, I guess. Finding it difficult to explain what that is, but $260 million is a little over 8 quarters worth of net income without the provision. So, ouch. So I would say, no matter what price this bank is being traded for in the market, I would not buy it. We could probably even stop there, right? There's no sense in going forward and figuring out, what's the other risk, what else is going on with the bank. But I'm curious to see how everything else is going on, so we can keep going. But I would be cautious about the credit risk and would avoid it altogether. Hopefully they work things out and make it through. But as is, there's just too much risk in the loan portfolio, and not enough conservative reserve to mitigate it. So anyway, derivatives, they don't have any cash flow or fair value hedges, so we can skip through that. The deposits, as we saw, they've got a lower amount of non-interest bearing deposits than we typically want. So there's some risk in the repricing of the on the liability side of the balance sheet. So all of these interest-bearing transaction accounts, savings accounts, time deposits, all reprice relatively quickly, and so there's risk that if once they do reprice, they reprice at higher rates, and that cuts into the interest expense. What's also risky to see is we can see most all of the time deposits. Well, not most all, but a lot of the time deposits reprice within the next year, which I guess is fairly common, but they seem to have a lot of time deposits as a percentage of the liabilities anyway. So, and then, pretty much all of them reprice within a few years. So that's a risk. It's also a risk of deposit flight as well. Once they mature, then the holders could potentially take them and use them elsewhere, at a different bank or in different investments or whatever. Another thing that's a really big risk, and actually really expensive, is that they have $4.2 billion of broker deposits. That's 49% of their deposits, and that's crazy high. We would normally see something between 4 and 8%, something like that. So them having half of their deposits being broker deposits mean that they're having a really tough time bringing in organic customers to deposit money into the bank, and they're having to go through brokers and then pay an extra percent for it, and man, that's just it's really unfortunate. And from the borrowing side, so bank term funding program, so they've got $1 billion, 1.7 billion outstanding. So 37 million comes from repurchase agreements, all right, and then $600 million from the FHLB, and then $1 billion coming from the Bank Term Funding Program. And then they've got some subordinated notes for about $70 million. It looks pretty common. I would think that the $37 million reprices could be on an overnight basis. Subordinated notes at least within 5 years or so, because they're normally fixed for 5 years and then floating for 5 years. But Bank Term Funding Program was a 1-year loan. Program itself, offered 1-year loans. So, I know that's going to be less than a year, and then FHLB we can see. But yeah, so they explain them a little bit down here. Yeah, so they mature in January 2025, so that's less than a year. Subordinated notes here. It says notes due September 1, 2024. So yeah, that's definitely going to come due and reprice in within a few months. And then they didn't talk about the FHLB. Oh, it has maturity dates here. Okay, September 25, 2024. Yeah, that's within a couple months as well. So basically all of this reprices within the next year, 1.7 billion. So that's that's not good for interest rate risk. And then the 1.3 billion of time deposits as well, and then all these savings accounts, interest-bearing transaction accounts. So I could see the liability side of the balance sheet starts to squeeze the profitability, but fortunately they're making good money on interest income on the loans, but on the flip side of that, they're doing it at really, really poor credit quality. So, even though they're earning more money at, what was it, like almost 7% on their loans, like how much of that is not going to be, how much of that yield is getting eaten up by provision, right? So it almost seems like it's not worth it to yield that much on the loans because they're just getting eaten alive on the provision. So, that's, yeah. Anyways, yeah, so we've beaten that to death, I think. Anyway, so let's kind of go through here. Fair value measurements. We typically compare, the balance sheet has the amortized cost for held maturity securities and loans, and then this footnote converts those to fair value so we can better see, like, well, how much are these things truly worth on the balance sheet currently. So it looks like the held to maturity securities go down by about 120 million, and the loans go down by almost 400 million. Yep. So you reduce the net assets of the balance sheet by about $500 million by converting it to fair value, which is actually about 40% of the equity, and that's higher than what we normally see. We usually see a reduction of like 24 to 38% whenever we do this exercise for most banks. So it takes a pretty big hit to equity, 40% of it, if we convert everything to fair value. So that's something to keep in mind and be alert for when you're considering like price to book values whenever you're looking at stock data pages and stuff like that, because it's not apples to apples for the banks that have all their securities as available for sale. Everything's at fair value, right? But the ones that have held to maturity on their balance sheet is not fair value, so you have to make this adjustment so you can compare the two appropriately if fair value of the net assets is important to you. Which it is to us. And so whenever you convert everything to fair value, it makes a price to book ratio of about 0.86%. So you remember, I think in the Yahoo Finance page, it was maybe about 0.44 or so. So so converting everything to fair value puts it pretty much doubles that price to book ratio, which actually still is a super cheap ratio. 0.86% you would be able to buy the net assets of the bank for less than their value standalone. So you would be able to, a lot of people could see this as a good value play. Like, what if you bought the bank and then sold off all the assets and paid off all the liabilities? Bam, you made 1 minus 0.86, so you made a 14% return. Boom. But as it is, if you're I think that's how that worked. Yeah. So if you're buying the bank as a going concern, as it's continuing, you're looking at potentially losses in the future due to the credit quality, and or at least like really, really low net income. So to make buying the bank worthwhile, that means you've got to buy the net assets for cheaper than what they're worth, because you're going to lose a lot of that value in the next couple years if the poor credit quality comes out. And so that's the risk that you take. But if you're buying the assets for less than their value, then you perhaps get compensated for that. And whether that compensation is enough to mitigate that risk is up to everyone's own personal risk tolerance. But yeah. So if you also from a capital liquidity standpoint, converting everything, all the net assets to fair value, would be about 6% of the assets at fair value. So 6% of the equity is 6% of assets is in equity currently. So, and that's pretty average. Most banks we see somewhere between 5 and 7%, something like that, of equity to assets at their fair values. And so, I feel like that's pretty good ratio. It seems like maybe the bank is well capitalized against all odds here. It may deteriorate going forward as a lot of the loans default and more and more provisions and that stuff like that. But as it is, it seems like they're a pretty average capitalized bank, which is great. So. So I think that's enough to discuss there, and we can get down into the MD and A. And getting into net interest income, net interest margin, we saw that the loans yield a pretty high amount, 6.95%. That's awesome, but it seems like it comes at the cost of credit risk, right? So kind of take that with a grain of salt. It looks like the investments yield pretty low. Wow, that's a really low yield, about 2%. So they must have bought those a while back. So if that's the case, then hopefully maybe they reprice pretty quickly. We'll be able to see kind of the repricing of stuff when we look at the call report soon. But anyway, so they have a little bit higher allocation to securities, if you remember, than they do to loans, at least in comparison to most banks. So that puts the 5.71% yield on earning assets, which for what we've seen for the past 15 banks or so, that's pretty much par for the course. And over the past year, for the ones we looked at, it was we usually see about 5% for the interest earning assets. So in the past quarter, we've seen a run up in interest yields, but this is pretty average for the most banks. So, but as we talked about, the bank has a really unusually high amount of, looking on the liability side, have an unusually high amount of broker deposits, which is a whole lot more expensive, not a whole lot more, maybe adding 1% to what you would normally pay an organic customer of the bank. So I could see the deposits yielding a whole lot more, being a whole lot more expensive than what we would see for most banks. And it looks like maybe that's the case. Yeah, I mean, like all of these are pretty much double of what we would normally see for most banks. So I think that is kind of as a result of having a lot more broker deposits. So ouch. 4.37% yield on the interest-bearing liabilities. That's almost double of what was present for the banks last year. So, and a lot more than what we've seen for the past dozen or 20 or so different banks we've looked at in the past month. So a lot of really expensive liability side of the balance sheet, but they're earning a little more on the loans, but actually the provisions and the credit quality is eating into that as well. So I feel like that they've got a really expensive, or the asset side doesn't yield as much when you're taking into account the provision, but also it's a really expensive side, liability side of the balance sheet as well. And so, on here it's about 2.5% net interest margin, which is low anyway. We're usually looking for 3%. But, taking into account the credit quality as well, I could see, if you added the provisions or the future projected provisions into the net interest margin, I mean, it would be even lower. So, and then, taking into account that they've got a really low non-interest income as well. I guess they don't really have any other services like wealth management or broker-dealer, insurance, anything like that. So they're really leaving a lot of money on the table by not having those services. So they're not making very much money on the net interest income, not making hardly any money in the non-interest income. Fortunately, they've got a pretty cheap expenses. You can see that the compensation's gone down over the past quarter, and that's probably due to they closed one of their branches, and several of their executives have resigned or been let go. So so you can see that last year they had 486 employees. Now they've got 451. So they're really downsizing things, restructuring things. There's big problems apparently that they're trying to turn around. So here they go into a little bit more detail about the loans. As we talked about, commercial real estate is the biggie here. It's almost $6 billion of their $8 billion portfolio. There's also some, from a regulatory standpoint, I believe there are repercussions for having more than 300% of equity of risk-based capital in commercial real estate. So they might touch on that whenever we get to the regulatory footnote, but they could be over allocated to commercial real estate. We'll see. But reading this paragraph here almost makes me cringe. Particularly so management believes that the CRE concentration risk is mitigated by diversification among the types and characteristics of real estate collateral properties, sound underwriting practices, and ongoing portfolio monitoring and market analysis. Clearly that's false, right? I mean, they've got way more problems in their loan portfolio than most banks. I feel like that. I know it's probably boilerplate template language, but it makes you cringe to read that. And it blames it on DC metro areas having a tough time, and that's why they've got the problems with their loan portfolio, the CRE portfolio. Yeah, we can see here, they for their office properties, almost $1 billion. It represents 11.2% of their loans. That could be some of the source of it. So we know there's vacancies in a lot of offices around the country currently. Yep, so 22% of commercial income producing commercial loans are office buildings. So Yeah, that's a lot of where their risk comes in. So we should probably be cautious for other banks that have such a high percentage of um, office loans. As I said, there's a lot of banks. I haven't seen a bank with as much classified loans and non-accruals as this bank has. So I don't know if this bank is uh, such a big problem is isolated to this bank, or if a lot more banks, but we should be cautious in that regard. But yeah, it says 250 million of the office properties are criticized or classified. We didn't take into account the criticized ones, but the classified loans were what, 350 million. So maybe a lot of them were office properties, and that's concerning for the banking industry as a whole. And then looking at this, we can see a little bit of the interest rate risk within the loan portfolio, and we can see that when we're looking at this, we've got fixed rates, adjustable rates. I usually consider the ones, even if it's a fixed rate, if it's maturing within 1 year, I consider it as kind of a floating rate or adjustable rate, because it's gonna reprice soon. So anyway, that plus the floating rates is about 73% of loans. So that, and actually there's a whole lot that are repricing within the next year, 2.4, and then in the year following that, 2.7, is at a floating rate. So I see that there's pretty low interest rate risk here. There's a lot of loans that reprice pretty quickly, and maybe that, hopefully that sort of mitigates what is, all the liability side of the balance sheet basically repricing within the next year, aside from the non-interest bearing deposits. But so we'll be able to look into that a little later once we get to that particular part of the MD&A. But that's interesting to note. Maybe the repricing of the loan portfolio saves us. But on the flip side, that potentially gives us credit risk as well, like where the loans mature or reprice, and then the customer isn't able to pay it or pay the higher rate that's repriced to. So that brings on even more credit risk. So sort of a catch-22 there, but Anyway, so moving on to the allowance for credit losses, they speak a little bit more about the CRE and the amount of reserve that they have in place and the classified loans. I think there's not very much to add to this than what we've already talked about. It says it believes it has taken a prudent posture with respect to risk rating its loan portfolio. Is this saying that less than 75% of its substandard loans are current? Okay, I see. Yeah, they sort of are trying to explain it away and not make it sound so bad. But my original thoughts on it still stand. I think I think there's too much risk in this to want to be part of it. Maybe in a couple of years the bank can work all this out, and we look at it one day and we're like, oh, this finally it's a great bank. But as of today, it's not. So yeah, so we can go on. Let's keep moving because this video is getting pretty long now. But 92 million of non-performing assets. That's a lot. At least as a percentage of assets, 0.79%. It's really, really high. The other thing I wanted to note, if we look at the deposits, one of our things that we always look at is the non-interest bearing deposits. How much is not costing anything, right? And when you compare it to last year, you see that they had almost 2.3 billion last year of non-interest bearing. This year it went down by almost $500 million. And then all the interest bearing accounts went up by 200 million down by about 100 million, about the same. Yeah, so basically they lost 400 million of the non-interest bearing deposits, and a couple of million of them went to interest bearing accounts, which cost them money, and then maybe 300 million went outside the bank, and for that they probably had to borrow from the FHLB, and that's probably apparent or discussed. Actually, yeah, let's look. So if we look at the balance sheet, yeah, the interest bearing goes up 200 million. Yep, so the borrowings go up about 300 million. Okay, so they now are having to pay interest on another $500 million, whereas before they weren't having to. So that's starting to eat into their expenses. Some of it they, at least for the increase to interest-bearing transaction account, or at least some of these deposits, they might have had to, that's where the broker deposits come as well. So really risky liability side of the balance sheet for those reasons, and then really risky side of the asset side of the balance sheet as well. So I feel like they're just kind of trapped, and yeah. So looking at the interest, liquidity, where are we here? Yep, so looking at the liquidity, one of the things that is good about the bank, I know we've been beating it down, but they have pretty good liquidity and also, off balance sheet liquidity as well. So, they've got about $700 million of cash. Most of their securities are encumbered, like they've pledged them, but they have about $400 million of unpledged securities, and then also about $4 billion of unencumbered loans. So, they have, with the amounts they've pledged to the FHLB and the Federal Reserve, they can borrow an additional about $1.9 billion. So if we were to add up the FHLB, no, that's what they have. So additional sources, yeah, so if we added up the 1.3 plus the 600, also 155 they could get from the Federal Reserve, they've got some additional sources, which equals about 82% of deposits, which is more than what we would see for the average bank. So that's basically on and off balance sheet liquidity. Now, if we were just looking at on balance sheet, we would look at how much cash do they have plus the unencumbered securities, and so cash of 700 million plus unencumbered securities of 400 million is about 1.1 billion. And that's about 13% of deposits, which is an average normal amount as well. So, I feel like they've got pretty good average liquidity, and and they've got a lot of loans potentially that are maturing pretty quickly, so they'll have more cash from that. So I think a pretty well robustly liquid bank. From a capital standpoint, we saw that converting everything to fair value ends up being a good ratio of assets, maybe about 6%. And, from a more typically used ratio of, common equity ratio gets us 10.85%. So that's almost 11%. And that's higher than than the range what we would see for most banks. We usually see, 9 to 10.5% of common equity ratio. So that's basically common equity divided by the assets. So, tangible common equity ratio, 10%, that's a lot higher as well. So, I feel like the bank is really well capitalized, and that's great because, because of the risks that they've got on both the asset and liability side that we've talked about. And also, even these regulatory ratios are really good, which is surprising because they have such a a large allocation toward commercial real estate, which gets dinged gets dinged in these ratios. So these ratios are actually higher than what we would see for the average bank, or at least like at the top of the average range that we would see. So I feel like this is a really good, well capitalized and appropriate liquidity bank. It's just unfortunate that the credit risk is so high. And yeah, this, they talk a little bit about, the regulations require, 100%, or they can't have more construction loans than 100% of risk-based capital, and they can't have more than 300% of risk-based capital in commercial real estate. So yeah, it says maybe they didn't exceed those amounts, but they are getting a lot more supervisory review due to their heightened commercial real estate. But they did get, they were over 100% on that. So, of course, on the construction, so getting a lot more supervisory review on things. Perhaps they're going to have to cut down the allocation that they have to those components, and which will be good to perhaps settle down the credit risk exposure there. Okay, so getting into the interest rate risk, asset liability management, all that kind of stuff, we can see that as the interest rates go up, they expect change in net interest income to be pretty muted. These are really small percentages, and it looks like actually, like, no matter which way the interest rates go, they still increase their net income, which is pretty unusual. But so we could say that maybe their interest asset liability matching, asset liability sensitivity is pretty neutral. And so we also sort of do our own calculations by looking at the call report and seeing, when do the securities reprice, when do the loans reprice, when do the deposits reprice, when does the debt reprice, and sort of come up with our own calculations as well. And we find the same thing, is that they've got good credit or interest rate risk. So even though we saw that most of the liability side of their balance sheet, maybe like 80% of it reprices within the next year. That's wrong. About 70% of it reprices within the next year. So that's a pretty big risk. But when you actually see the repricing of the loans, we see that 66% of the loans reprice within the next year. So about $5 billion of the liabilities reprice within the next year, but also $5 billion of the loans reprice within the next year. So those two things offsetting each other really help with the interest rate risk, and really puts it at a neutral place. The securities, as is typically the case, most of them mature 5 years and farther from now. But that's not necessarily atypical, but it is nice to see that the loans reprice within really quickly, and that helps combat the repricing of the liabilities. So really good interest rate risk. So I think that gets us to the bottom of things. As we saw, to kind of summarize everything, this is a bank that I think there's no price that we would buy it at, and there's probably a price somewhere that would come to it, but as a continuing company, there's too many issues with the credit quality, but also on the liability side of the balance sheet. So let's from a profitability standpoint, we saw that they basically made no money this year, and not this year, but this quarter, because of the provision, and we were hoping that the provision was a one-time thing, but it turns out that they're even still, I feel like, under reserved for the credit for what they should reserve given the credit quality. And so that makes it to where we can't say that provision was a one-time thing. So, and we even looked at the credit quality where we compared, classified loans to what the reserve is, and the difference was about 260 million. So does that mean that they're going to have to reserve an additional 260 million over a period of time? And if that's the case, and their company usually makes $30 million a quarter, then that's over 8 quarters of income to support that, and that's just not. We're not in the business of buying losing banks, and they've got I feel like it's going to take them a couple years to work all this out, and maybe at that point they'll be able to come out shiny, and we'll gain interest again. But unprofitable bank, and the credit quality is really, really bad. They had past dues, non-accruals, classified loans that were all, almost 3 times what the average bank has relative to the loans in place. And then a reserve that's the average bank's reserve, right? So if the credit quality is 3 times worse, we would want the reserve to be 3 times worse, or 3 times more. And that's not the case. So we can't say that, we would say that credit quality is probably one of the worst bank that I've seen so far. And but on the interest rate risk, they have really good interest rate risk. A lot of their loans reprice within the next year, and that helps combat a lot of the problems on the liability side. A lot of the repricing issues where 70% of the debt, or 70-80% of the liability side reprices within the next year, but actually a lot of the loans reprice, which helps kind of keep things neutral. From a capital liquidity standpoint, I feel like they've got good liquidity. I think they had somewhere between 13% of their deposits on balance sheet liquidity. Also, the ability to borrow from FHLB, Federal Reserve, an additional amount of money, which on balance sheet and off balance sheet wholesale funding, is a little over 80% of the deposits. So I feel like they've got really good liquidity and in a position to where I don't think that they would go defunct or something like that. They're pretty well capitalized, as also evidenced by converting everything to fair value and seeing the common equity ratio, that sort of thing. One of the bigger risks, I think, I don't know which of the risks bucket you put this into, but half of their deposits are broker deposits. So those are pretty expensive, and we sort of subtract those from their core deposits, right? So we're looking for a lot higher percentage of their deposits being from core organic customers, right? Because those are a lot more sticky. So that's a big risk as well. But as it stands, it's a bank that this past quarter was unprofitable, and we expect a lot of credit losses going forward, which could potentially make it be unprofitable or below the average bank's profitability over the next couple of years, which would be unfortunate. And so then, therefore we don't want to invest in it currently. But their interest rate risk, I feel like, is solid, as well as the liquidity and capital. I think they've just got to work themselves through this loan portfolio. And so yeah, that's what we think of this bank. Let me know in the comments if there's anything that I missed, or if you agree or disagree. Yeah, I'm looking forward to hearing what you think, and thank you for listening.